Commercial real estate lending just plunged to the lowest levels in over a decade, and banks are continuing to tighten the screws even harder in 2025. So if you are financing deals, if you are raising capital for your properties, or you are investing in syndications as a passive investor, and these syndicators are leveraging debt, then this is a shift that could make or break your returns. We're going to talk about it in today's video. Hey, what's going on, wise investors? Welcome back to the channel where we help you build wealth in commercial real estate. In Q4 2024, commercial real estate loan growth slowed to just 0.14% quarter over quarter, which was the lowest pace in 11 years. And at the same time, the Fed's Q1 2025 Senior Loan Officer Survey, where they take the pulse from all of the lenders in the debt industry and commercial real estate, they confirmed that significant net shares of banks reported tightening standards for all types of commercial real estate loans. And that includes lower loan-to-value ratios, meaning you got to bring way more cash to the table, higher debt service coverage ratios. They want shorter interest-only periods, which obviously was a very big benefit to investors that had certain types of projects that need interest-only debt. And they are also showing that they want much smaller loan amounts and restricted property types and markets, which overall just slows the amount of capital that is coming into the commercial real estate industry. So in translation, capital is getting much harder to find and more expensive to secure, making deals much more challenging to pencil and meet the returns that many investors have for their investing goals. Now, especially for investors without deep banking relationships or bulletproof underwriting, this has shown to be a very strong headwind that has slowed many investors in the commercial real estate industry. So why does this matter to you as a commercial real estate investor, somebody that participates in the industry as a whole? Well, deal volume is theoretically drying up in a very large way. We're seeing fewer loans, fewer closings, and longer timelines. And overall, the velocity in which things are happening in the commercial real estate industry has slowed down to a snail's pace. You can see one of my previous videos that shows commercial real estate sales year over year and how drastic this drop actually is. Now, regional banks are also under pressure. These lenders, if you're not familiar, fund over 2/3 of all commercial real estate loans, and they're pulling back the hardest. Many of these banks have a lot of debt already on their books from lending over the last 5 years post-pandemic that are going through some challenges right now for obvious reasons that we have seen and experienced over the last few years. We're also seeing private credit is rising, but it's coming at a cost. Higher interest rates, tighter covenants, and much less flexibility, which is making things, again, more challenging to model deals that actually work and are worthwhile for taking the risk and putting your chips in the table, right? And taking all of the time and energy and resources that are required to bring a lot of those models to life in real time. This shift is redefining what a financeable deal actually looks like in today's market. And if you're not adapting, you are at risk of getting left behind. So what can you actually do if you're an active sponsor, if you're an operator? Number one is to secure financing early. Start being proactive and have these conversations as far in advance as you possibly can to understand all your options and how they tie into your model. So whether that is a credit union, a private lender, a seller carry option, right? Exploring all the different facets of how you can put a capital stack together is going to be extremely important to looking at your deal from a different set of lenses and many different angles. Also, making sure that you are just stress testing your deal models and adding in an additional 100 or 200 basis points in rate sensitivity. Lower your LTV assumptions and that the bank isn't going to give you as much debt as you thought you would be able to get when going for leverage previously. And maybe rework your debt service coverage ratios to determine if these deals actually pencil based on the way you are setting up your capital stack. I would also say just build in more time, right? Lender timelines are stretching. So giving yourself the buffer or the opportunity to bake those into your acquisition or refinance plans is extremely important. Now, if you're a passive investor and you're investing in other people's syndications as an LP, right? This is where you really want to lean in and ask sharper questions during the due diligence period. Who's lending on your deal? What is the debt service coverage ratio? What's the LTV? Are there any specific loan covenants that we need to be aware of? What are the reserve requests? What happens if refinance rates jump 150 or 250 basis points in your model? Have you accounted for that in your underwriting? Also just looking at sponsors with strong banking relationships and a track record of low leverage or just performing accordingly, going full cycle in and out of a deal, also being in multiple market cycles and understanding how to navigate those. That wisdom, that experience is oftentimes you can't pay to get that unless you experience. So aligning with those types of individuals and overall, just avoid aggressive underwriting. The days of, rose-colored lenses and blue sky scenarios are long gone, and we're already seeing what is happening to many of those people, those syndicators who modeled that way and didn't, plan for worst-case scenario, because ultimately that's what's happened and why so many syndicators and LPs now are getting caught in this market cycle. So look for operators building in those buffers and showing real conservatism and that the deal still works even with those things happening. And last, I would just say private credit funds are stepping in, but with the higher rates, right, demanding stronger collateral and writing tighter terms, this isn't the Wild West of easy money. The best operators are going to be the ones who are going to adapt. They're going to communicate with lenders. They're going to look at all options. They're going to find a way to put the puzzle pieces that are available to them to get the overall picture and goal achieved. And that is where the structure matters. Making sure that you've got great structure on your capital stack with the team and the overall demographics of your deal. They have to be there, especially in times like right now. This isn't just a temporary slowdown. It is a structural reset in a lot of ways in the commercial real estate lending landscape. And the people who thrive during this shift will be those who understand the new capital reality. So if you want to stay ahead of the curve, get real-time insights, and build your portfolio with precision, don't forget to subscribe to this channel, follow the podcast, leave a comment down below. What do you think? What are you seeing out there in the industry right now? I've been saying this is the season of seller finance. I'm closing on a 100% finance deal on a small mobile home park here in the next week. And the only reason why this lender was willing to come to the table was because they understood all of these macro. So this just isn't a temporary slowdown. This is a structural reset in the commercial real estate lending landscape. And the people who thrive during this shift will be those who understand the new capital reality and ultimately are just taking this data and they are using it to their advantage and protecting their downside. There's always going to be a bull market in every bear season of a real estate cycle. You just got to be proactive in how you go about finding these opportunities. So is the commercial real estate industry, when it comes to lending, actually going to collapse? My answer is no. We just have to find a way to mitigate the risks that are there because there are real headwinds, and we need to make sure that we are still being very proactive in arbitraging and capitalizing on the upside, which is still there in many different deals and in the industry as a whole. So I'm curious, what are your thoughts? What are you seeing out there? How are you navigating this challenging terrain? These are the seasons that ultimately are my favorite because when it is stale, when it is slow, when it is challenging, this is where the creative and the proactive and the urgent are the ones who find a way to stumble in to some great opportunities. So if you want to stay ahead of the curve, you want to get real-time insights, you want to build your commercial real estate portfolio with precision and just do it as best as you possibly can to achieve your goals, then of course, subscribe to the channel, smash that like button on the video, and drop your comments down below as well. I'm a student here looking to learn just like you are, and the more we can collaborate in this wise investor community, the more we can all benefit together. Don't forget to check out all the great resources, links, and tools down below. Until next video, stay smart, stay liquid, and keep building your wealth wisely.